This is Dr.T Varalakshmi discussing you about the definitions and terminology in the Unit 5, that is Introduction to the Financial Accounting and Financial Analysis as a part of Business Economics and Financial Analysis. Unit 5 is the Introduction to the Financial Accounting and Financial Analysis. Once a product demand is identified with the demand forecasting methods, then the next thing is they have to think about how to produce that product and what cost they have to implement. So the cost is implemented and they have to choose the best market to sell and the organization establishment to sell that particular product. That is the market and business environment. So once they have started a business, they have to see how to get the funds and how to allocate that funds. Under this Unit 4, we have discussed under the capital and capital budgeting. Then the Unit 5 is every rupee they are spending strategically, but they have to remember each and every transaction. If it is a memory of a person, the people will come and go. There must be a replaceability for the memory of the people. So that is called as the accounting, which means they need to record, maintain a proper books of records for the every activity which is taking in the business. That recording of rupee comes in and rupee goes out from the organization or to the organization in a systematical manner is called as the financial accounting, and how they will analyze this is called as the financial analysis. Here we will have the discussion about the financial accounting objectives, functions and its importance, and the rules, regulations and the guidelines under the concept of accounting concepts and conventions, and different methods in maintaining the books of records like double entry, bookkeeping, journal, ledger, trial balances, and the final accounts preparations, that is trading, profit and loss account, and the balance sheets with the simple adjustments, and the financial analysis, that is after the final accounts, how to interpret them with the using of the activity ratios, liquidity ratios, inventory turnover ratios, capital structure ratios, and the solvency ratios, and what is the use of this dew point chart, that are going to be discussing under this Unit 5 of Introduction to the Financial Accounting and Financial Analysis. So let's have a look on the concepts of the financial accounting. So what is meant by the accounting? Accounting is the activity of recording, classifying, summarizing and interpreting of the business transactions in terms of the cash, the preparation of the financial reports, and the analysis and interpretation of these reports for the information and guidance of the management. So it is a recording the financial transactions. So which means quantitative elements are only taken into the consideration, not the qualitative elements. For example, 4 employees are all there. What is the salary to the 4 employees is 1 lakh rupees, means that 1 lakh only takes into the considerations. Like what is the quality parameters, that efficiency is not considering here. So for this 1 lakh, capital has brought, from this capital how much is paying under the salaries. So which means they are all recording the financial transactions. After recording, they are analyzing, they are classifying what is coming in, what is going out, and summarizing, is it balancing or not. Then they are all interpreting, which means what is the profits and expenditures at gross profit levels, at net levels, and finally what are their assets and the liabilities positions. They are all communicating. To whom they are communicating? To the users. Who are the users? Means the management, employees, customers, competitors, governments, etc. So all these users has to take the best decisions based on the financial recordings of the organization. That financial recordings in a proper manner, recording, classifying, summarizing, interpreting, analyzing, communicating, that processes is called as the accounting. So next thing, what is the purpose of this accounting means? The main purpose of this accounting is to determine the profit and loss during a particular time period. So that is the accounting period means generally from April 1st to the March 31st of the next year. And to show the financial conditions of the business on a particular date and to have control over the firm's property. So, for example, an employee is there. If he is expecting more salary hikings, then he can see this balance sheet of that organization. Okay, my company is going to be growing, so that he can expect more salary hikings. As a customer, if you see that one, the stability of the income is maintaining by the organization, strengthening of their balance sheet, we can say that okay, he can purchase that products so that he can see the sustainability of that particular products. So, and communicate financial status, assist decision making, comply with the law, that is the government has to implement some taxation policies, and if they has to plan the future activities and have to ensure the controlling the assets, etc., they can more concentrate on this accounting activities. That's the purpose of this maintaining of the accounting. And in this one, the functions of this financial accounting is through some steps. That steps are all the bookkeeping function, that is the journal. This is in the form of journal. Then classification under the ledger. Preparation of the financial accounting, that is trial balances. And next thing is trading account, profit and loss account, balance sheet. So these are all the step-by-step procedures. Step-by-step procedures in functioning of the financial accounting. So that all the steps which are involved are called as the ledger, journal, ledger, trial balance, trading account, profit and loss account, and balance sheet. So finally, they are all seeing the total assets and the liabilities position of the organization, then it is defined as the balance sheet. That is study of the individual's firms or a consumer. It is also called as a theory of firm. In simple terms, it is a statement that shows the assets and liabilities of the firm in a overall accounting period is called as the balance sheet. For example, if a shareholder is having the 100 rupees, so with this 100 rupees, he has purchased the raw materials worth of raw, raw materials worth of the 100 one, and he has taken 200 rupees worth of the loan, and he has paid 100 rupees as the wages and 50 rupees as the tax, and remaining 50 rupees for the transportation. So now, so for the 300 equivalent, his liability as well as his equity, is that amount is tallying or not, is going to be balancing or not, is going to be evaluating with the help of this balance sheet. So that's why the equation of the accounting, that is assets is equals to liability plus the shareholders equity, is going to be verifying with this balance sheet. What is a profit and loss account means? A profit and loss account is prepared to ascertain the net profits or the net losses of the business concerned for an accounting period. So for every organization, profits are all based on their expenditures. As we are all know that one, it is based on the expenditure. Expenditures are two types: direct expenditures, indirect expenditures. So if the product is there, and for that one, the labor charges, rent paid for that, any one machinery charges, etc., will be called as the direct charges. They are all called as the direct charges. Indirect charges are all advertisement cost, and for the operational salaries which they have paid for the administrators, etc. Any other additional that is interest rate paid for the amount loan which they have taken. So here it is the indirect expenditure, it is the direct expenditure. From the direct expenditure, and the direct income for the organization is sales revenue, etc. So from this one, if their expenditure is less, sales is more, we can say that profit. If the sales is less, expenditure is more, we can say that loss. But it is a direct one. So if they provide this information in any format, then it is called as the trading account. So here we can get either gross loss or gross profit. Now after this one, if we add this indirect expenditures or the indirect incomes, then there is a chance of getting net profit information or the net loss information. The statement which is showing this net profit and net loss information is called as the profit and loss. Then write any 4 accounting concepts means, so generally we can see 13 concepts are all there. That is entity concept. Business is separate, organization is separate, and the owners are separate. So that the owner might be changes, but the business name will be continues. And cost concept. Everything must be in terms of their expenditures. And going concern concept. The organization is going to be run for the long run basis. And accounting period concept. So time period from transactions starting and ending, that is April 1st to the March 31st. And money measurement concept. Everything should be in money measurements, that is quantitative only, qualitative is they should not take into the consideration. And it should be a dual aspect, one is adding and one is subtracting, that is credit and debit. So if the goods are coming to the organization, cash is going out, that is both has to identify. And accounting equivalent, so they have to maintain in a proper books of records with the principles, matching principles, and variability of the objectives. And realization concept, once it has done, then only they have to take into the consideration. Imaginary should not take into the consideration. Capital concepts, capital has to include. Accrual concepts, if anything has to yet to come, they have to take under the accrual income. True legal positions and rules and regulations they have to follow. All these are all the concepts. If any 4 accounting concepts means, we can go for this, any of this one. And conventions means disclosure convention, compulsory they have to show all the information. And materiality convention and consistency in maintaining their methods and books of records. And conservation convention. All these are all the concepts and conventions. So if they ask you 4 accounting concepts means, you can mention any of these concepts and conventions. So next thing is ratio analysis means, for example, a milk is there. In that milk, in the pure milk of 1 glass, 2 glasses of water is mixed. We can say that milk and water is in 1:2 ratio. So which means the total 3 glasses of liquid is there, where 1 glass of milk, 2 glasses of water is there. So that is a mathematical expression between 2 variables. Here, the ratio is also like the mathematical expression between the 2 variables of the accounting concepts, that is called as the ratio analysis. Here, profitability ratios, that gives the analysis on how well the firm is organized its activities in profitable manner. That is gross profit margin ratio, net profit margin ratio, operating profit margin ratio, return on assets ratio, return on equities ratio. All these are all will comes under this profitability ratios. Whereas the current ratio gives the liquidity position of the organization, that gives the difference between the current assets to the current liabilities of the organization. And if any person is having the highest current ratio means they have the more liquidity cash to spend. Low current ratio means they have having less money to spend, easily ready for the organization. And liquidity ratios is a combination of current ratio, quick ratio, and cash ratio. So whereas current ratio gives the overall 1 year position, quick ratio means money which is ready to spend, cash ratio means that only in the form of cash at hand and cash at bank if they considers, then it is called as cash ratio. Then Solvency ratio is the organization is a position to repay its debt or not, that expresses the financial position of the business, then it is called as the solvency ratio. And the meaning of the journal. So journal is a first book in which transactions are recorded in chronological order the moment they takes place in the business. For example, a transaction is there. Purchase the goods from Raghava on credit basis means credit basis they have purchased means they need to remember Raghava. On cash basis means they need not to concentrate on Raghava. They can directly take cash into the consideration. So goods account as a purchases account as well as the Raghava account in terms of the credit basis. If it is cash basis, purchases account and cash account, because goods purchased means goods are coming to the organization, whereas the cash is going out from the organization, whereas the Raghava is the giver to the organization on the in the case of the credit basis. So here any of this one we have identified two accounts, we have to enter them. So goods are coming to the organization, so there are three types of accounts are all there: personal account, real account, nominal account. If it is belongs to any persons, artificial persons or the natural persons, then it is called as personal account. Here the rule is debit what comes in credit, debit the receiver, credit the giver. And if it is a real account, then the rule is debit what comes into the organization, credit what goes out from the organization. If it is a nominal account like salaries, wages, etc., the rule is debit all expenses and losses, whereas the credit all incomes and gains. Based on these rules, they will maintain the journal books, and this is the format for the journal entries like date, particulars, ledger folio number, amount, the debit amount and credit amount. Then the next one is a ledger. All the accounts are all daily they are maintaining in the journal. If one particular account is separately maintained in this entire monthly wise or quarterly wise, and finally yearly also. So what is the total amount of that particular one account? Purchases. So different dates it has done. So in all the dates, purchases information is accumulating at one place, then it is called as ledger for that purchases account. That means it is a book that contains several accounts, and the process of preparing of the accounts from the journal into the ledger is called posting in the ledger. Here it is, its a format is like a name on the title of that particular account: purchases account, cash account, capital account, etc. So left side the debit, right side corner it is the credit, date, particulars, ledger, journal folio number and amount. It is double folded. So that is date, particulars, for journal folio number and amount. Trial balance. It is a pre-verification of the transactions done is called as a trial balance. That means it's a statement that is containing the debit and credit balances of various accounts taken out from the ledger book as a particular date is called as a trial balance. Then what is meant by the activity ratios means the ratios that expresses how active the firm is in terms of the selling its stock, collecting its receivables, paying its debts is called as the activity ratios. That is inventory turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratios, etc. will be comes under this activity ratios. So that's about the ratios and accounting terminologies related to the unit 5 of this business economics and financial analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.